back to the GEX Private Equity Academy podcast. I'm Vanamali, CEO of GEX Management, managing partner at GEX Capital, and the founder of GEX Private Equity Academy. Today, we're talking about one of the most widely used and often misunderstood metrics in private equity, EBITDA. If you've spent any time around private equity, investment banking, mergers and acquisitions, or business valuation, you've probably heard of EBITDA discussed repeatedly. Businesses are often valued using EBITDA multiples. Lenders focus on EBITDA. Investors focus on EBITDA. Management teams focus on EBITDA, and for good reason. EBITDA can provide a useful measure of a company's operating performance. But one of the biggest mistakes investors make is assuming EBITDA tells them everything they need to know about a business. It does not. And that is where many first-time investors make expensive mistakes. In fact, two businesses can generate identical EBITDA and represent completely different investment opportunities. Let me explain. Imagine two companies. Each generates $10 million in revenue and each generates $2 million in EBITDA. On paper, they look almost identical. If all you reviewed were the financial statements, you might assume that they are worth roughly the same amount. But what if one company has hundreds of customers while the other has a single customer representing 30% of revenue? Suddenly, those businesses look very different. What if one company has recurring revenue and long-term customer relationships while the other depends on winning new projects every quarter? Again, very different businesses. What if one company requires very little ongoing capital investment while the other constantly needs new equipment, vehicles, or facility upgrades? Same EBITDA, very different economics. This is why I spend so much time trying to understand the quality of earnings, not simply the amount of earnings. One of the first questions I ask when evaluating a business is, how sustainable are these earnings? Can the company continue producing similar results over the next 3 years, 5, or even 10 years? Or were the results driven by temporary factors? Maybe the company landed a large one-time project. Maybe a competitor exited the market. Maybe an unusual industry event temporarily boosted performance. Those are important questions because investors are buying future earnings, not historical earnings. Another area I spend a great deal of time evaluating is cash flows. A business may generate strong EBITDA while producing very little actual cash. How is that possible? Working capital, capital expenditures, inventory requirements, equipment purchases, growth investments. All of those factors affect how much cash ultimately remains available to owners. For example, a construction company may report strong EBITDA while still consuming significant amount of cash because it has to finance projects, purchase equipments, and carry large accounts receivable balances. Private equity investors care deeply about cash flow because cash flow supports debt repayments, acquisitions, reinvestments, and ultimately investment returns. Management quality is another factor EBITDA cannot explain. Two businesses can produce identical financial results today. But if one management team is exceptional and the other is struggling, investors may evaluate those opportunities very differently. The same applies to competitive positioning. Does the company have long-standing customer relationships, a differentiated service offering, barriers to entry, pricing power? Those factors don't appear directly in an EBITDA calculation, but they can have a significant impact on long-term performance and valuation. One concept that we discuss frequently in private equity is risk-adjusted returns. Not all EBITDA is created equal. A business generating $2 million of highly predictable EBITDA may deserve a higher valuation than another business generating $2 million of highly volatile EBITDA. And why is that? Because predictability reduces risk. And investors generally pay higher multiples for businesses that produce stable, recurring, and sustainable earnings. Ultimately, EBITDA is a useful starting point. It is a screening tool. It's an important valuation metric, but it is not the entire investment process. The best investor looks well beyond EBITDA. They evaluate industry dynamics, customer relationships, management teams, competitive positioning, cash flow generation, growth opportunities, operational risks, and value creation potential. Then they bring all those factors together to determine whether a business represents an attractive investment opportunity. So the next time you hear someone say a company is worth 7 times EBITDA or 8 times EBITDA, remember that the multiple alone does not tell the whole story. The better questions are, how good is that EBITDA? How sustainable is it? How predictable is it? And what risks exist beneath the surface? Those are the questions experienced investors ask, because in private equity, it is rarely just the amount of EBITDA that creates value. It's the quality, predictability, and sustainability of those earnings. Thank you for joining me for this episode of the GEX Private Equity Academy podcast. If you would like to continue learning how private equity investors evaluate real lower middle market acquisition opportunities, I invite you to join the GEX Private Equity Academy Insider List. As an Insider List member, you will receive our complimentary Private Equity Starter Kit, transaction insights, educational resources, and invitations to select live private equity case study sessions. If you found this episode valuable, I would also appreciate if you subscribe to the GEX Private Equity Academy YouTube channel so you do not miss future podcast episodes, acquisition case studies, and other educational content. To learn more or to join the insider list, visit www.gexprivateequityacademy.com. Thank you again for joining me. Until next time, keep asking better questions, keep evaluating opportunities, and remember, do not just look for great businesses, look for great investment opportunities. Thank you.